Welcome to Spiedel's Federal Tax Minute. I'm your host, Catherine Sedan. This week we're covering the tax issues that prediction markets might present and the lack of IRS guidance on the issue. Get all the news you need to keep your clients current, as well as new tax planning strategies to minimize taxes throughout the year with a subscription to Spiedel's quarterly federal tax update webinar. Sign up today for all 4 of our topic-driven webinars or just a single session at Spiedel.com under webinars. Mainstream prediction markets like Kalshi and Polymarket were adopted around 2022 and traded negligible volume up until 2024, when total annual volume reached $16 billion and has grown to tens of billions of dollars per month in 2026, according to the Pew Research Center. Prediction markets are online platforms where people bet on the outcome of future events, like who will win an election, which team will win a game, or whether inflation will go up or down by the end of the year. Instead of placing a traditional bet, participants buy contracts tied to a specific outcome. These contracts are usually priced between $0 and $1, and the price reflects how likely the market thinks that outcome is. If a contract costs 70 cents, the market believes there's roughly a 70% chance the outcome will happen. If your prediction turns out to be correct, your contract pays out $1. If you're wrong, it's worth nothing. Interestingly, prediction markets are structured as financial derivatives or contracts rather than traditional sportsbook-style betting. In a classic betting model, an individual places a wager against the house, which sets odds, takes the opposite side of every bet, and profits from the spread. In prediction markets, individuals trade standardized contracts with one another on an exchange, so the individual's counterpart is another individual, not the platform or the house itself. The IRS has not yet provided any guidance, formal or informal, on the income tax treatment of gains and losses from prediction markets. Prediction markets appear to most closely resemble wagering, which would subject the taxpayer's prediction market gains and losses to the code's rules for gambling. This means gains from wagering transactions are included in gross income, and losses from wagering transactions are deductible only within the limits of IRC Section 165 subsection D. And IRC Section 165 subsection D limits wagering loss deductions to 90% of actual wagering losses and only to the extent of wagering income. Due to the IRS's lack of guidance on prediction market income, taxpayers may prefer to argue that such income more closely resembles the sale of capital assets, resulting in capital gain reported on Form 1040 Schedule D, or a Section 1256 contract reported under the mark-to-market rule. This argument is bolstered by the fact that the U.S. Commodities Futures Trading Commission, or CFTC, takes the position that the sale of prediction market futures contracts falls exclusively under the agency's jurisdiction to regulate derivatives. A preliminary injunction was recently issued against the enforcement of a Minnesota bill signed into law in May 2026, which makes it a crime to operate, host, or promote a prediction market in the state. The injunction was issued against the state of Minnesota because federal law preempts state law, allowing the CFTC to regulate futures contracts. However, the CFTC's treatment of prediction markets as the sale of regulated contracts does not bind the IRS. When the IRS ultimately issues guidance on prediction markets, the IRS's guidance will take precedence for tax reporting purposes. The rapid growth of prediction market volume should hopefully force the IRS's hand to issue guidance sooner rather than later. Spiedel's Federal Tax Letter is a monthly newsletter plus a searchable online archive of back issues that keeps you at the leading edge of the issues that will impact your clients, from healthcare to trusts, and from LLCs to virtual currencies. Get details and subscribe at Spiedel.com under Publications. That's all for this week. Join us next time for another episode of Spiedel's Federal Tax Minute.